The SBA 7A loan is one of the most talked about small business financing products in the country. It's also one of the most misunderstood. Most business owners either think they don't qualify when they actually can, or they apply before they're ready, get denied, and walk away thinking it's not an option for their business ever. In this video, I'm going to break down exactly how an SBA 7A loan works, what lenders are actually evaluating when they underwrite your file, and what the path looks like from application to funding. And I'm going to show you a real client story, a business owner who was stuck in daily MCA payments and walked out the other side with a $350,000 SBA loan at a prime interest rate plus a couple points. So you can see what this actually looks like in practice. So let's get into it. The SBA 7A is the flagship loan program of the Small Business Administration. When most people say, I want an SBA loan, this is the one they're talking about. It is a term loan. You borrow a fixed amount, repay it over a set period at a set interest rate typically, but it's backed by a government guarantee. The financial institution or SBA approved lender is the one loaning you the money, but the SBA is guaranteeing up to a certain portion of that bank's funds, which is what makes the terms so favorable compared to conventional lending. Because conventional lenders that are SBA preferred, they're going to lend you more if the government is guaranteeing up to a certain portion of that loan. Here's what that guarantee actually means in practice. The SBA is not lending you the money directly. An approved lender, a bank, a credit union, or an SBA preferred non-bank lender is making the loan. The SBA guarantees a portion of it, typically between 75 and 85%, which means if the borrower defaults, the government covers most of the lender's loss. That guarantee is what allows lenders to offer longer terms, lower rates, and lower down payment requirements than they could on a conventional loan. For the borrower, this translates to real structural advantages. Loan amounts up to $5 million, repayment terms up to 10 years for working capital, and up to 25 years for deals that involve real estate. Interest rates tied to prime, currently in the 7.5 to 9.75% range for most borrowers. There are also way lower down payment requirements than conventional commercial loans or alternative commercial loans. There's no balloon payments, and they fully amortize over the loan term. That last point matters more than people realize. No balloon payment means your cash flow planning is predictable for the full life of the loan. You know exactly what's coming out every single month. For a small business owner, that predictability is worth a lot. Lenders evaluate 5 things when they underwrite an SBA 7A file. Understanding these is the difference between a strong application and one that quietly dies in underwriting. One of the first things they're usually going to look at is your personal credit. Most SBA preferred lenders want to see a 680 or above to move a file forward smoothly. I do see approvals in the 640 to 670 range, but those typically require collateral, a down payment, or exceptional debt service coverage to compensate. If your personal credit is below a 640, the SBA conversation usually needs to start with a credit rebuild plan, not a loan application. It could start with a loan application for alternative finance that you can use the capital to help to rebuild your credit and then use it as a bridge into an SBA, but that's about it. Debt service coverage ratio, DSCR. This is a number most business owners have never heard of, and it's often the one that actually decides the outcome. DSCR measures whether your business generates enough cash flow to cover the new loan payment with room to spare. And by cash flow, I mean net profit, not revenue. SBA lenders typically require a 1.25 DSCR or higher, meaning for every dollar of debt payment, you need to be generating $1.25 in available cash flow. If your DSCR is below a 1.25, the underwriter is going to have a problem regardless of what your credit score looks like. They really need to make sure that you're profitable enough to afford the monthly loan payment and still grow your business. The time in business and revenue history is what they look at next. 2 years of documented business history is the absolute standard threshold for SBA 7A loans. There are maybe a handful of lenders that will get you an SBA 7A loan with less than 2 years of business tax returns, but they are extremely difficult to qualify for. 2 years of business tax returns, bank statements that support the revenue figures, and ideally financials that show a stable or growing trend. Lenders are not just looking at what you earned, they're looking at whether the pattern is predictably positive. Business credit profile. This one surprises people. SBA lenders pull your business credit in addition to your personal credit. If your business credit profile is thin, no trade lines reporting, never took a loan out, no paydex score from Dun & Bradstreet, inconsistent entity information, that's a big deal killer. It creates gaps in the automated screening that can stall or kill an approval when everything else looks good. Use of funds. SBA lenders want to see a specific defensible plan for how the capital will be deployed. Working capital is not a good use of funds for an SBA loan application. The stronger application would say, we are purchasing this equipment, expanding to this location, refinancing this specific obligation. Clarity reduces perceived risk. I want to show you what this looks like in practice with a real client. I'll call him Marcus. Marcus came to us convinced that his only option was another merchant cash advance. His business had strong monthly revenue. By the way, this happened at the beginning of 2025, before the SOPs for the SBA changed from SBA loans not being able to refinance MCAs. Marcus's clients paid him on time. His team was solid, but he had one MCA with daily payments coming out of his account and no idea that he was actually an SBA candidate. When we ran his full credit analysis, here's what we found. Personal credit was above 700. DSCR was well above the 1.25 threshold. He had clean tax returns. He just didn't know how to use them because he put his information in on Google and somebody told him all he needed was bank statements. And it was also a low-risk industry. On paper, he was a prime SBA borrower. The only thing blocking Marcus was a business credit profile that was essentially invisible. There was no paydex score, no vendor trade lines reporting, inconsistent entity information across bureau and state filings. The automated screening systems had nothing to evaluate from Marcus. So the only products that had been offered to him were high-cost, short-term ones. We cleaned up his entity information, opened vendor trade lines that reported, and within 60 days, got his paydex score into the range that SBA lenders look for. And then within 90 days of that rebuild, he was approved for a $350,000 SBA 7A loan at a prime interest rate with a 10-year term and monthly payments. Let's go. He used the proceeds to pay off his existing advance, which freed up over $20,000 a month in cash flow. And he still had working capital left to deploy into growth. The business didn't change. His credit worthiness didn't change. The only thing that changed was Marcus's file now told the full, accurate story of a business that was already qualified. Let me walk you through what the SBA 7A application process actually looks like so that you can get your file pushed through like Marcus. Step 1, pre-qualify. Before formally applying anywhere, you need to know where you stand on the 5 factors I just walked through: personal credit, debt service and cash flow, time in business, business credit profile, and use of funds. If you have gaps, it's far better to identify them before applying than to find out mid-underwriting that you just wasted a bunch of time. Multiple declined applications with hard credit pulls can actually weaken the file that you're trying to get approved as well. So it's much better to be proactive about preparing your file for an SBA loan as opposed to just applying to every single lender that offers SBA loans that you can find. Step 2, choose the right lender. Not all SBA lenders are the same. SBA preferred lenders have delegated authority to approve loans without sending the file to the SBA for separate review. These are very few and far between. This significantly speeds up the process. Different preferred lenders also have different appetites for different industries, loan sizes, and borrower profiles. Matching your file to a lender who actively wants it is one of the highest leverage things you can do. There are certain lenders that have preferred industries, certain lenders that have preferred cash flow structures, but it's up to you to either work with somebody that understands that or find the right lender on your own. Step 3, document assembly. The SBA 7A requires a full document package to get started. Most lenders ask for at least 2 years of business tax returns and 2 years of personal tax returns. But it's honestly better to provide 3 if you have them. 3 to 12 months of business bank statements, depending on the lender, a current profit and loss statement and balance sheet, and a personal financial statement, as well as a debt schedule listing all current business debt obligations. And depending on the lender, a business plan or a use of funds narrative or schedule may be required as well. Step 4, underwriting. This is where the lender reviews your complete file against SBA guidelines and their own internal credit policy. Expect questions. Expect to have to provide more documents. Lenders will ask for clarification on specific line items, explanations for revenue fluctuations, documentation of anything that looks unusual. Respond fast. Underwriters have multiple files in queue, and slow responses can create significant delays in your loan. Step 5, approval and closing. You're almost there. Once approved, you'll receive a commitment letter outlining the loan terms. Review everything: rate, terms, fees, prepayment penalty provisions, collateral requirements. Then closing, which involves signing the note and any security agreements. Funding typically follows within 1 to 3 days of closing and signing the loan docs. The total timeline from complete application to funding is typically 30 to 90 days, depending on the lender, the program that you're applying for, and the complexity of the file, as well as how quickly documentation is turned around. Let me be direct about the most common reasons SBA applications get denied, because most of them are fixable with the right preparation. Credit below threshold. If personal credit is below 680, the path forward is a structured credit rehabilitation plan, not submitting applications and hoping, paying down revolving balances, resolving any derogatory marks, letting positive payment history age a little bit, or restructuring your debt in a manner that takes things off your personal and moves them to your business. These are the levers. It takes time, but the SBA is worth waiting for. DSCR below 1.25. If your cash flow doesn't cover the proposed payment with enough cushion, adding collateral can sometimes compensate, but the underlying issue is either that the loan amount is too high for the current revenue level, or that the financials aren't telling the full story. Sometimes the fix is a smaller loan amount. Sometimes it's making sure all revenue is properly documented. Thin business credit profile. This is the most fixable issue and the one most often overlooked. Setting up and using vendor trade lines, ensuring consistent entity information across all bureau and state filings, keeping business credit card utilization in check. These are things you can do right now that pay very high dividends in 60 to 90 days. Prior defaults or judgments. Most SBA lenders will find these. If there are prior defaults on government-backed loans, all SBA lenders will find these. That's a hard stop. Other judgments or collections are evaluated on a case-by-case basis. A documented explanation and resolution can sometimes overcome them, but it depends on the lender. I cover the full SBA loan landscape in detail in my book, The Hero's Journey to Capital, including the 7A, the 504, microloans, fast track loans, and startup programs, along with exactly how to position your file for the best possible outcome. Chapter 6 specifically covers what opens up for established businesses and how to match the right SBA product to your stage. The link is in the description if you're a reader. If you're wondering whether an SBA 7A loan is realistic for your business right now, or if you've been told it's not an option and you're not sure why, come talk to us. At Small Biz Heroes, we review funding files every single day. We'll run a real underwriting analysis on your situation, tell you exactly where you stand on the 5 qualification factors that I went through in this video, and give you a clear picture of what it would take to get approved or get you approved through the right lender, whether that's today or after a 90-day preparation window. Grab a time to talk strategy with my team at the link below for free, and subscribe for more SBA and business funding content every week. I'll see you in the next one.